Awesome. Today, we're going to cover measuring success and how do venture capitalists evaluate investment performance. So in my mind, I kind of break this up into two general buckets. One is pre-exit, one is post-exit. What do I mean by exit? Well, when I make an investment, an exit is when I'm able to exit that investment or sell it off. So like I buy shares from a company and then I sell those shares, I exit the investment when I've sold it to somebody else, whether the company gets acquired or they go public, or heaven forbid they file bankruptcy and nobody buys it, but they're just worthless, so I throw them in the trash. An exit is basically when I'm out of the investment. And because of that, for VCs, like getting to an exit is like the most important thing in a lot of cases, because you're investing in like highly illiquid, super risky companies that take years and in some cases decades to get to an exit. And it really doesn't matter, like all the metrics really don't matter pre-exit. All that really matters is like when you exit it, how much money did you make for your investors? That said, because you're locked up for such a long time, VCs have to be able to evaluate the performance of their investments over time to get an idea of like which investments look like they're doing well and are being successful and merit additional investment, as well as to be able to report back to their investors that are limited partners, the health of the portfolio. So I thought I'd break it up into these two general buckets, and we'll talk about the metrics that VCs look for in each set. So first, let's talk pre-exit. So these are the companies that sit within the venture fund's portfolio. And in general, I would say VCs look at revenue growth, quality of that revenue growth. So I'll give you a story. We once looked at this deal where the company was growing super fast. They went from like 200K to over 2 million in a year. So 10x revenue growth year over year, right? But when you peeled back the onion to look at the actual growth, what we realized is what they were doing is they would create a bunch of content for their customers, and they would basically sell that content at cost. And that content was like underpriced relative to the rest of the market, because what they were hoping is that they would make the content and then the customer would also subscribe to their software that tied to the content. But in reality, what was happening is all these customers were like, oh, this is great. You're basically giving away content at a very cheap price. Sure, I'll do that. And then I'll sign up for your software product. And as soon as like a year is over and the contract's done, I'm going to bounce, but I'm going to keep the content that I bought super cheap. So quality of that revenue actually matters. But if you got good quality revenue and your revenue is increasing and growing quickly, those are usually strong signs that customers like your product and that you're being effective at selling and marketing it. The other thing that you really look for as a VC within your portfolio or other companies that you're potentially going to invest in is customer loyalty or churn, or how much do customers really love the product? How much does it solve their need? If you've got a product that's doing a phenomenal job at solving a need for that customer, it's very unlikely that they're going to stop buying the product or paying for the product or what have you. And so churn rates tend to be super valuable when looking at the success and performance of a business. In fact, some of the very best businesses are so successful at creating value for their customers, even the customers that they end up losing are more than offset by the customers that stick around and not only stick, but expand their relationship with that company. That if you look at like their churn rate, it actually is like negative from a revenue perspective. Or in other words, like they're gaining more money from those expansions than they are from losing them. The next one is the company hitting specific milestones? Now, for example, if you invest in the seed stage of a business, you want to see them get to about $2 million in revenue before they're able to raise a Series A round, right? And so you would be tracking that company to see like, hey, are you making good progress with the money you have on hand to be able to get to that milestone? So in this case, to 2 million in revenue or at least 2 million in ARR. Once a company hits that, right, then it's well positioned to raise a Series A round, and that would be one way that you might measure success. A lot of funds will, especially seed stage funds, will track the number of portfolio companies that they invested in that make it to a Series A round. Because a Series A round is usually viewed as like the first like real institutional VC round where the company has achieved product market fit and now they're looking to really start scaling the business aggressively. And so that can be like a big milestone. The milestones vary little by little, right? So Series B stage companies, it's typically like, okay, you figured out product market fit at your Series A, and now you took that money from your Series A and you built out a really robust sales and marketing engine, right? And once you've done that and you can demonstrate that at the Series B round, then it's all about like, okay, great, let's start building out your entire organizational structure so that can support you becoming a really big business. And so there are these like specific milestones all along the way. And then of course, like you want to be able to demonstrate like good revenue, low churn, a lot of those things that demonstrate that you're still operating within a large market and solving those pain points for those customers. And those are like generally the like key metrics that matter. I mean, every business is going to be a little bit different, but holistically, what you're looking for as a VC is you want to be able to say like, yes, this company is growing. It's growing fast. It's starting to dominate its market. It's solving a real pain point and has the potential to become really big. And if it does that, then it'll be able to raise more money at higher valuations. And ultimately, those higher valuations are what the VCs are able to report back to their investors and say, hey, look, our companies are in our portfolio are doing well because as they grow, they're attracting additional capital at higher valuations from other investors. And then the VC is able to report back essentially what are paper gains on their portfolio. Now, the trick with these paper gains is that they're just that, they're just paper, and you can't really eat the paper, right? It's not the same as cash. And so it's not uncommon to see venture funds post, especially early stage venture funds, to post like really nice paper gains in the early days, right? Because they invest at low valuations and those companies, like they're growing and they haven't hit any sort of like major thing that shuts down the company, especially in the early days. And so everything looks good and rosy and up and to the right. But then over time, right, like these things happen and companies fail. And so it's not uncommon to see paper returns kind of plateau and in some cases even decline as those paper gains are turned into realized gains. All right, let's talk about post-exit. Now in post-exit, there's really only three things that matter, right? I don't really care about the revenue growth anymore. I don't care about, the branding or the number of customers I have or the churn rate. The only thing that matters is what kind of return am I generating for my investors, right? So if you look at that, what are the three metrics? It's cash returned, it's multiple of cash returned relative to cash invested, and it's IRR, or internal rate of return. Let's talk about each one of these. So for cash returned, for example, like what matters is getting like a giant payout, right? So I'll give you an example. I once made an investment in a company that generated an 8x return. Now that's the multiple on invested cash metric, right? So I put in, X number of dollars and I got 8 times that at exit. That's great. 8x is a great return. But what you should be asking yourself is, okay, but how much money did you put in, right? And in this case, it was a really small amount. I actually put in, I think like $80, and then I sold it for like $700 or something like that. The point being that $700, hey, I mean, that's great. I made $700, but it didn't really it's not going to change my life. If I had invested, $80,000 and I got $7 million back, that would probably be like a more life-changing event, right? So cash returned is the first one. And, that's probably the one that matters the most. The next one is that multiple on invested cash. So shooting for, 10 times your investment, right, is pretty common for investors. 10 to 20 times. Really, some of the best investments return 100 times and even 1,000 times their original investment. And then the third one is your internal rate of return. And the reason why internal rate of return matters is because I can generate a 10x and I can generate $1 billion of cash returned. But if it took me 100 years to generate that, that's not really that helpful, right? I'm not even going to be around long enough to enjoy it if it takes that long. And so IRR helps create or put in place a time metric on the returns and the performance of your investments. So an IRR is an internal rate of return. And what it basically says is it's calculating exactly how much your investment grew each year between the time you made the investment and the time you exited it. So for example, if I put in $1 and next year I get $2 back, then my ROI is 100%. And my internal rate of return is also 100% because it went up by, it doubled. It went up by 100% in that year. If it goes to 2 years, let's say I invest $1 and in 2 years I get $2 back, well, my ROI is still the same. It's still 100%, right? I made 100% on my investment. But my IRR drops down closer to 40%. And the reason for that is that basically what I'm saying is I have $1 and in year one it went from $1 to $1.40, and then in year two it went from $1.40 to roughly $2, right? And that's how you get that 40% because each year increased by 40%. And that's the IRR. And so if you have an investment that takes a very long time to generate a huge return, that's great, but it might have a much lower internal rate of return. Alternatively, you might have an investment that doesn't return a lot, but it returns it very fast, right? So you doubled your money in a year, you generated 100% IRR. Well, IRR matters because your investors are giving you money as a venture capitalist, you're investing that, and then as you get returns, you're sending that money back to them. And they have alternatives of where they could put the money. So for example, they could put the money in the stock market, which generates on average about 10% over the long run. So if you're able to generate even just a 2x, but it's 100% IRR, that's awesome for them because that's 10 times what they would normally get in the public markets, right? And so they like that. The flip side is, generating a handful of 2x's and that's it is not going to really benefit your fund, especially if you consider like power law distribution, where you're going to lose like a third of your investments, another third are basically going to kind of break even, maybe they generate a 2x, and you're really hoping for that last third to generate the bulk of your returns. And so as a VC, like you're really shooting for high IRR, high cash on cash, a total high cash payout, right? Like frankly, I would rather have a low IRR and a low multiple, but a huge cash return than having really high numbers in the other two buckets. That said, all three are very valuable metrics and ways in which VCs evaluate the performance of their individual investments as well as their entire overall fund and how they get evaluated by their limited partners. And if you're trying to assess like where should a venture fund be in all of these numbers, I would say like really great venture funds consistently generate about 3 times their fund. So if you're managing a $300 million fund, which is pretty average, then you would return $900 million, almost $1 billion back to your investors off of your investments and generate an IRR somewhere in the 30-ish% range. Maybe a little less if you're more growth stage oriented, lower risk, maybe a little bit higher if you're earlier stage, seed stage risk. But hopefully that gives you a rough idea. And then each individual investment, really you're swinging for like 10x and 50 to 60% IRRs, knowing that not every investment is going to generate that kind of return. And so, the losers kind of offset the winners and pull you into that 3x and that 30% IRR range after fees and everything else. Anyways, if this video was helpful, check out my other video where I talk about how to prepare for a venture capital interview. This video I just covered is a really good one to watch as you prepare for applying for a job in venture capital, but be sure to check out that one as well. Thanks.